Welcome to the 3 Edge Week in Review for the week of October 21st. I'm Fritz Folts, Chief Investment Strategist here at 3 Edge. Joining me here once again today, Steve Cucchiaro, CEO and Chief Investment Officer here at 3 Edge Asset Management. Today, Steve and I are coming to you in person from corporate headquarters here in Naples, Florida. And this week, we are going to discuss how we see U.S. equity markets have made new highs over and over again this year. And we know that our research indicates that the U.S. equity markets are significantly overvalued, and yet they continue to go higher. We know that it's important to understand valuations. They're foundational to an investment process. But it seems to me, when I think about it, well, maybe valuations aren't important until they are. And so could you sort of explain that? Because eventually they do come into play.
That's correct. So valuations are very poor predictors of short-term market moves. Valuations are totally disconnected, have nothing to do with what the market's going to do today, tomorrow, next week, next month, et cetera. Valuations are incredibly outstanding, extraordinary predictors of how the market performs over the next several years, 5, 8, 10 years. They've proven that time and time again. That's why they're so important, but one must know that they don't drive the short term, that global macroeconomic factors can be very important in the intermediate term, and especially in the short term, behavioral factors. So we have a market here that there's an element where it's going up because it's going up. As it goes up, it keeps attracting more capital. People follow the trend, et cetera. And there are a whole host of examples in history where overvalued markets have continued ever higher until a catalyst comes along to change their direction. But it is true that we find the markets severely overvalued.
So clearly, our research indicates that U.S. equity markets, for example, are significantly overvalued. Why is that the case? What are the factors that are leading us to that conclusion?
So what we've done is we've looked at the major components of valuation of the stock market. We look at the price to sales ratio, which is a key component. We look at very reasonable assumptions about the discount rate, which are interest rates going forward in time. We look at very reasonable assumptions about the growth rate of earnings and sales going over time. And what we found is that today, the market is not only severely overvalued, but it's overvalued to the extent that there are only 2 other times in history that have been in the same era, same phase. One was in 1929. The other was in the year 2000. And the third is today. That's how overvalued we are when I put all those factors together. Now, some people, and I'll read in the financial press, some people claim, well, no, the markets are fairly valued. So we ran a research test on that. We said, well, what if we assume that today the markets are fairly priced, they're reasonably valued? What does that mean about assumptions that have to happen in profit margins over time going forward? What does that mean about assumptions that have to happen about the discount rate or interest rates going forward? And after doing a very comprehensive calculation, what we find is that if one were to believe that the markets are fairly valued today, they would have to assume that profit margins, which are for the S&P 500, which are 12%, that's after-tax profit margins, which are nearly as high as they've ever been in history. They'd have to go from 12% up to 26% and stay there indefinitely.
Yeah.
Or conversely, if we do it from the interest rate side, the risk-free 10-year treasury bond yield would have to drop to minus 2%. And that's not over inflation, that's nominal, minus 2%, and stay there indefinitely. So either you believe that the markets are fairly valued today, and either the profit margins are going to skyrocket more than double ever before, or interest rates are going to go below where they ever have, minus 2%, and stay there forever. Or you have to conclude the markets are overvalued.
Okay, so if we are to assume that the markets are significantly overvalued, but at least throughout this year, they have continued to move higher. So what can one do as an investor to try to continue to participate, but be careful because of the significant overvaluation levels, which you just discussed?
So our models are showing we can continue to hold equities, not fully invest in equities. That would be way too much exposure to potential downside loss, but continue to hold sufficient equities at this time to participate in continued upside should that take place. But hedge in two ways. One is we know with our flexible portfolio structure that we can go through the exit door, we can reduce equity allocation
Right.
If our early warning signals in our model suggest it's time to pull back. And that could happen at any time. Secondly, with what we own in addition to equities, we can be very thoughtful about how we hedge.
Right.
And rather than just follow the traditional rule that, well, you just hedge with long-term bonds, we think that's a particularly ineffective hedge in today's environment. In fact, long-term bonds have not been a good hedge since the summer of 2020, pretty much the entire time since then. But depending on what the catalyst might be to knock the equity market down, gold can be an excellent hedge because gold can protect against geopolitical conflict exploding. It's gotten hotter and hotter, and it could get even worse over time. And gold would be a great hedge against that. Commodities can be a good hedge. Let's say the oil price spikes to over $100 a barrel because in the Middle East, they closed the Straits of Hormuz. We'd want some exposure to commodities, and oil is included in those commodity indices. We'd want some exposure to very short-term treasuries. If the black swan were to come out of the blue and affect the markets, if we were to find that, in fact, we got into credit contraction, if maybe after the election, the fiscal stimulus coming from the government tailed off, and we found that there wasn't enough liquidity to keep propelling the markets, we could get into that credit contraction situation, and we want the best asset under a credit contraction, which is short-term, low-duration treasuries. And we've noticed that ever since the Fed cut rates by 50 basis points, inflationary expectations have actually been going up.
Right. Yep.
And so TIPS can be a good protection against higher inflationary expectations. So that is how we would protect our portfolio.
And still participate. Excellent. So that will do it for Steve and me for this week's edition of the 3 Edge Week in Review. We will be back again next week with our next edition. All our videos are always available on our 3 Edge YouTube channel. If you feel someone might benefit from them, please feel free to share them. And if you are enjoying watching these videos on a weekly basis and would be so kind as to subscribe to our 3 Edge YouTube channel, we'd be most appreciative of that as well. So on behalf of Steve and everyone at 3 Edge, thanks for listening.